Hi, welcome back. I'm Valerie Fuson with Keller Williams, and this is David Schneider with Advanced Residential Solutions. In this section, we're going to discuss the homeowners' options who may be facing foreclosure, loss of equity, and higher mortgage payments. The homeowners' options?
Absolutely. The homeowners have approximately 8 solutions available when they fall into foreclosure. Some of the options relate to repayment plans. A couple options relate to actually giving the property back to the bank. And then, of course, there's the option of selling your home at less than what's owed, also known as the short sale. In these options, you could probably go through one at a time and sort of discuss some of the pros and cons of each. The first option that I think that's introduced to the homeowner is the forbearance plan. And really a forbearance plan is simply a repayment of the missed payments or the outstanding arrears to the bank, and it's just a restructuring of those payments without any reduction or discounts or rewriting of the loan involved. So what happens is if the homeowner misses 3 payments, the bank may just add those 3 payments onto the back of the loan, and they continue to make their normal payments. Other forbearance plans include adding the missed payments onto the next 6 months' regular payments, thereby making most of those payments unaffordable to the actual homeowner. The second solution is the loan modification program. There's been a number of government programs that are assisting the banks with this solution. The loan modification is actually a rewriting of the loan. In some cases, they can extend out the payments up to as long as 50 years. There are other solutions such as a trial loan modification, whereas the homeowner can go through a trial period to test whether they can afford the payments and whether that solution is one that's doable by the bank as well as the investor of the lender of the loan itself. So and then there's a qualification period there that the homeowner will go through to see if they can afford it, and then the banks can decide if that's something that they can afford to go forward on a long-term basis. What we have found with the loan modifications, though, is that there's been a high redefault rate with that solution, and so therefore homeowners would fall back into foreclosure as a result of 2, 3, or 4, or 5 missed payments or payments being made and then falling back in. I think the statistics were negative against the program. I think within the first year, as much as 60% of the loan modifications were failing. Another solution to the foreclosure is for the homeowner to file bankruptcy. There's a couple of different types of bankruptcy. There's the Chapter 7, and then there's a Chapter 13. What we found is that most homeowners would file a Chapter 7 in trying to eliminate their debt. However, filing a bankruptcy does not stop the foreclosure process. That just puts a freeze on the foreclosure while their bankruptcy proceeds through the courts. And so they are provided protection during that process. Again, we do suggest that all homeowners seek legal counsel if they are considering a bankruptcy, because it is a legal process. Another solution is the deed in lieu of foreclosure, whereas the homeowner will deed the property or the home back to the bank in lieu of going through a foreclosure. Again, this program varies from bank to bank because of the different lenders and investors involved on the loan side decide whether or not they will actually file an actual foreclosure on the homeowner's record or credit report. And that's a huge deciding factor, in my opinion, in terms of a deed in lieu. The deed in lieus also aren't a viable solution if there's more than one mortgage or lien on the property, because the bank needs to receive that property back free and clear of any junior liens. So any property with more than one mortgage would not qualify for a deed in lieu program. However, if the solution results back to either a foreclosure or a deed in lieu, obviously we would recommend that the homeowner pursue a deed in lieu if their lender will accept that. Refinance is an option that was considered initially by most homeowners. However, because most homeowners in foreclosure are upside down on their homes, which means that the value of their property is less than the mortgage balance, most people are not eligible for refinance. In fact, I think a couple years ago, if somebody had greater than 70% loan to value, they would not qualify. And in fact, I think that may be down as far as 50% nowadays. So that is a very limited solution. And of course, there's the foreclosure itself and walking away from the home. That's something that obviously we don't recommend, because then there is a severe impact on the homeowner's credit as well as their eligibility of getting another mortgage within the next 5 to 10 years. So there's what we've heard is that there's what's called jingle mail, where the homeowners would actually mail their keys back to the bank and just walking away from the mortgage because it was just unaffordable at that point. There is another solution called partial claim. The partial claim is an FHA program. It's for homeowners who have an FHA loan, where the FHA program, if they qualify, will allow them, or actually loan the homeowner enough money to bring their loan current. And then that loan will become a junior lien on the property. So that partial claim is actually only eligible for homeowners who have FHA loans, or only homeowners who will be eligible for that program. And then finally, there's the short sale solution. In the short sale, the homeowner is attempting to sell their house for less than what they owe to the lender. And there is usually a negotiator involved who will work with the lender to arrive at a settlement of the actual mortgage, and enabling the lender, actually the homeowner, to sell the home at that point. And obviously, we're involving realtors and attorneys with closing and so on. So it is a lengthy process for both the homeowner, the realtor, and the attorneys, as well as the bank in this solution. So which I think we'll go into next.
Mm-hmm. And there's one thing interesting that you were talking about. I think a lot of people have the misconception that when you're talking about the bank, that they have the ultimate say. But you mentioned about the investors.
The actual investors, that's a great point. The investor of the loan is an institutional investor. There are lenders who service their own loans, where, in other words, a lender such as, let's take an example, Chase Manhattan or JP Morgan Chase nowadays will loan money to a homeowner to purchase a home. They then own the loan, and they will also service that loan. However, there are other investors, or there are other lenders who will actually loan that money to a homeowner. They will close on the purchase, and within 2 months they will actually sell the loan off to another lender, or sell off the servicing rights of that loan to another lender. So they may keep the loan as their loan, however they may sell off the servicing rights to another lender. So it might be serviced by, say, Bank of America, even though the loan is actually owned by JP Morgan. So when I refer to the investor of the loan, it is the lender who owns the loan, or who bought the loan from the initial originator.
Mm-hmm. Yeah, and I think that's where we're having some problems, because the homeowners are thinking that their bank isn't willing to negotiate with them, and it's the investor that comes in with more guidelines.
Exactly. It is actually the investor's policy and procedures that the servicing lender has to follow. So for instance, in the case of the Fannie Mae's, Freddie Mac's, and FHA loans out there where they're insured by these government agencies, the lender will make their decision and approval. However, then they have to pass the file on to Fannie Mae, Freddie Mac, or FHA and gain their approval as well. So there's actually more than one party who actually approves the short sale discount and acceptance of that short sale. And then you also have, in addition to the government agencies, you have the private mortgage insurance companies out there who insure loans higher than 80% of the mortgage balance for the lender itself. So therefore, there might be a PMI company that has a say in the decision.
Okay, that's interesting.